thank you for joining V-Guard's Q1 FY19 result call. From the management team, we have Mr. Mithun, who's the Managing Director, Mr. Ramachandran, who is the COO, and Mr. Sudarshan Kasturi, who is the CFO of V-Guard. So I request Mr. Mithun to start with a few opening remarks, and post this we'll open the floor for the Q&A session. Over to you, sir.
Thank you, Bhargav and Ambit, for hosting this call. A very warm welcome to everyone present, and thank you very much for joining us today to discuss the operating and financial performance of our company for the first quarter ended 30th June 2018. We have made a steady start to the year, delivering a top-line growth of 19% in Q1 FY19, adjusted for the GST-related price impact on a low base last year. The growth was driven by digital UPS segment up 24%, electric fans up 34%, electric water heaters up 22%, wires up 21%, kitchen appliances up 92%, switchgear up 65% segments. We have also received a good response for the recent launches in kitchen appliances and modular switches segments. A weak summer adversely impacted the growth of stabilizer and pump categories, which reported modest growth of 3% and 5% respectively. We are making good progress in penetrating and improving our brand visibility in the non-South markets. We are continuously expanding our product portfolio and gaining scale in these regions. Non-South market recorded a robust growth of 30% YOY on a like-to-like basis in Q1 FY19, and now contribute to 44% of overall sales as compared to 40% a year ago for Q1. Gross profit for the quarter was up 26% YOY to 193 crore, with underlying improvement in gross margins adjusted for GST price inflation at 150 basis points YOY. EBITDA grew 39% YOY to 49.7 crore. EBITDA margins have improved to 7.8% in Q1 FY19, up 150 basis points. ATL spends were to the tune of 29.8 crore, which represents 4.7% of sales in Q1 FY19 versus 18.3 crore or 3.2% of sales in Q1 FY18. This was up 63% in line with the expected spillover from brand rejuvenation exercise last year. Ad spends will revert to normative levels from Q2 FY19 onwards. Our PAT grew 48% YOY to 34.4 crore. Cash flow from operations was robust to the tune of 67.7 crore in Q1 FY19 as compared to 57.5 crore in Q1 FY18. Working capital cycle has improved by 2 days to 62 days. Further, 13 crore of GST refund is still pending to be received from the Government of India. In addition, our balance sheet continues to be robust with a net cash of 138 crore as on 30th June 2018, providing a platform to pursue inorganic opportunities if valuations favor. Our return ratios continue to be strong despite the significant investments made in brand building over the last 2 years, with ROE and ROCE of 18.2% and 22.2% respectively for trailing 12-month basis in Q1 FY19. Our new brand identity reinforces the new age values that we would like to imbibe in our endeavor to create thoughtfully smart and technologically intuitive products for the discerning customers. V-Guard today has evolved into a healthy pan-Indian consumer brand and business, emerging as one of the potential leaders in our space. We are now laying foundation for the next stage of growth. We will position ourselves to competitively benefit from the developments in the consumer market and technology space in order to future-proof ourselves. We have built a strong network of almost 30,000 plus retailers and plan to add 3,000 to 5,000 retailers across the country every year for the next 5 years, with higher additions happening in the non-South region. We have undertaken several business strengthening initiatives over the last few years and have a strong execution track record and demonstrated ability to grow market share and improve profitability. We remain confident of maintaining our 15% growth trajectory over the next few years, driven by continuous expansion into non-South markets, efforts on innovation, R&D and new product development in order to roll out differentiated offerings. We welcome the reduction of GST rates from 28% to 18% on consumer durables such as mixer grinders and storage water heaters, which we have fully passed on to our consumers. We believe that the rationalization of rates and other steps taken under GST will stimulate consumer demand and formalization of the economy. On that note, I would like to thank you once again for your participation and would like to hand over the floor to the moderator for question and answers. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question at this time may press star and 1 on your touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Renu Bed from IIFL. Please go ahead.
Yeah, hi, good evening, sir. So my first question is, if we, as in the presentation, we have mentioned that the southern markets for us grew by just about 12% for the quarter. So overall, can you help us understand which were the categories which got impacted more? At least segmental numbers such as stabilizers and pumps, but other seasonal products like fan also fall as in under the seasonal bracket. So basically, which were the product segments which got impacted because of the skewed summers, especially on the southern market?
So in South, it is specifically, stabilizer, primarily AC stabilizer. So the stabilizer business degrew in South by about 12%. The single phase pump degrew by about 7%, in South. These are the two categories that really pulled down the overall numbers. In fact, the fan business grew by 14% because fan, we are still a new,
Fans grew 24% on like-to-like.
Okay, 24% like-to-like and 14% on, reported. So the main degrowth is coming from stabilizer, which degrew by 10%, single phase pump by 2.3%, a three phase pump by about 40% because it's, it's on a very small business comparatively. The fan business actually grew by 24%. These are so mainly stabilizer and, pump business, which actually pulled down the entire, South business down. The three-phase pump is extremely seasonal and volatile in their demand because it's extremely dependent on agricultural inputs and rainfall. So the three-phase pump within the single-phase pump really got impacted in places like Karnataka, which is our largest market for pumps today.
Right. And so this quarter, as in this was the first quarter when we had for the new category in the air cooler segment. So, and the summer, given the southern markets were weak, how do you think V-Guard would have fared in this difficult environment in the air coolers market? And what was the initial response from the market for your product?
So I think, we have just launched and we did a revenue of about 3 crores for the first quarter. Please bear in mind this is with the very limited, models and very limited market launches. So we have launched it sporadically in North, East and in, erstwhile Andhra. These are the only 3 areas we have launched the product. So I think the 3 crore number is pretty decent considering we had absolutely very limited number of models. What I could understand from my colleagues is that we have had a good sellout. So almost about 70% of whatever we have sold sold out. I will just ask my CEO Ram to also,
Yeah. So basically, our objective for the first year was mainly to establish the supply chain and, to sense the category. So we did not have any objective in terms of, doing numbers. We wanted to get a sense of the category as we were not there before in the category, and we wanted to establish the supply chain and be confident that we are able to make trouble-free products. Yeah, and we are also able to establish what I would say our price positioning and our value proposition. So that's really what we were testing, and I think that in that context, I think we got very good results. What we understand is practically, whatever we have sold into trade has got sold out. Yeah.
But what would have been the volume if you can share the number of units?
So number is 3 crore. I think if you take an average value of 6,000 rupees, it should be roughly 5,000 units.
Sure. And so my second question quickly, as in this quarter, obviously with pump stabilizers being a bit soft, gross margins have improved smartly. So would you attribute largely to mix element here, or you see structurally the ability to pass on the price increase to the consumers has picked up? And should we expect these gross margins to sustain for the year to come?
Margins have improved in categories like fans and DU, digital UPS. So that's in line with our plan. These are categories where we are on a, it's a priority for us to be improving margins. So
we have done a lot of work in the last 4-5 years on both fans and digital UPS. We have killed all the existing models and we have refreshed the entire lineup. We have launched close to 25 SKUs in digital UPS alone and maybe another 25 in batteries in the last 2 years. In the case of fan, maybe another 20-25 SKUs has been launched in the last 4-5 years. So we've completely revamped the product portfolio in both these products, and the work on MPD is now showing results both in terms of sales and in terms of gross margin. And that's completely at what we were working on, because these two products were not EBITDA positive 4 years, 5 years back. Today, at least, fan is really making money, and DUPS has also become EBITDA positive, and we are expecting that also to make the same kind of margins in line with fans in the next 1 or 2 years.
Sure. Thank you so much, sir. I have more questions. I'll come back in the queue. Thank you.
Thank you. We have a next question from the line of Sonali from Jefferies. Please go ahead.
So thank you for the opportunity. So my first question is, in your cables and wires segment, you have shown a 10% year-on-year growth and like-to-like growth of 21%. So could you give an approximate breakup of how much of this is led by volumes and how much by price?
volume growth is 10%. The remaining is price.
You are saying this for the 21% like-to-like growth?
Yes.
Yes. Okay. Volume growth is also around 10% because the copper prices are probably similar to the same levels. It was
for the reported number.
For the last financial year.
Sure. So secondly, in terms of South versus non-South markets, could we have an approximate understanding of what the margins are in South versus that of non-South?
So the gross margins are as of now almost similar, is what we could...
It's about 1% difference.
Sure. All right. So in terms of distribution strength, we have mentioned that we would be adding about 3,000 distributors every year. What is our current strength across India?
See, not 3,000 distributors, 3,000 retailers. So we have close to 30 to 32,000 retailers. That is end retailers as we speak, and we are looking at like 10 to 15% growth in that number every year. So from 30 to 32,000 to 35 to 37,000 is what we will be targeting this year, and every year with an addition of 3 or 4,000 retailers every year.
Sure. So my last question is any guidance on capex?
Our normative capex will be between 35 to 45 crore, and this year also it should be almost in line with that, in the normal average capex.
Sure, sir. That's it from my side. Thank you.
Thank you. We have a next question from the line of Prashant Kuti from Sundaram Mutual Fund. Please go ahead.
Hi. Thank you for the opportunity, sir. So first question is on the stabilizer side. You highlighted that the growth rate largely in South was impacted. While I understand one of the reasons could be the AC's growth would be a little lower, but in general, is the stabilizers growth low across all the consumption segments?
No. If you look at the Q1, the biggest contributor for sales volume and sales value is the AC segment, because AC average stabilizer pricing is about 1,200 to 1,400 rupees. Vis-a-vis the non-AC segment average pricing is between 800 to 1,000 rupees. So even both by volume and value, AC is the almost 50% of volumes and maybe 60% of value of the total stabilizer business. So the decline has come from mainly that side. The other two segments have reported modest growth, that is both the television and refrigerator segment. But the dependence on AC is so high in Q1 that overall number is, looking very low for, South.
Okay, so safe to say that this is probably just because of the season going wrong. Here on probably should the growth rates improve because a Q2 while has a very high base, but Q3, Q4 again is a very bad base in terms of stabilizers growth. So what would be your outlook be as far as stabilizers growth is concerned?
See, the best way to map the stabilizer business is to, watch the air conditioning sales market in India, both in South and non-South. So that will give you a sense of how our sales is likely to happen. If you look at us 2 years back, we had a growth of almost 25 to 30% on a huge base in Q1. And after that, we have remained flat for the next 2 years. So I think if summer does pick up next year, we will again see a big improvement in the number. It should improve. So we have had 2 consecutive years of poor summer or not so great summer. In fact, this year IMD had predicted for a very warm summer, and in fact we were all excited and we were preparing for a very warm summer, but it was completely converse. In fact, we have got record amount of rainfall in April and May. So that way it has been a very weird weather. Having said that, we saw the north markets really pick up for us for air conditioner stabilizers because there we got summer from May 15th to June 15th, and east also contributed a little bit. So overall overall stabilizer looks decent, but south has really impacted. So since we are high market share holders in south, our growth will depend on the market growth, which is dependent on the AC sales growth.
How would the north market growth been for stabilizers? Any idea on that?
So I don't know the north number, but non-south has grown by 15% like to like, and 12% in actual sales.
Okay, for stabilizers.
Yes.
Okay. So second question is on the growth rates. You've highlighted that you still continue to maintain a 15% kind of a top line growth. While if I look at this number, currently reported number of about 14% for the quarter and about 19 like to like, that's on a base of almost a flattish number last year. The rest of the year we are almost now back to a normalized base. Q2 again you had a very good quarter. Q3 was a good quarter. So just wondering, anything which is changing from a demand perspective that's giving us this confidence of a 15% top line growth?
See, I've seen this business for last 11 years, and what I've noticed is that, very rarely, if most of the time when we do have a bad Q1 because of destocking by trade because of poor summer, there is also equally aggressive upstocking the following March and following February. So that is why it is giving us confidence that fundamentally there's not something wrong with the demand. It's a summer-based issue. Adding to that, now government has reduced GST from 28 to 18, which means almost a 10% reduction in prices. If this doesn't spur demand, I'm not sure what will. I mean, I'm talking about huge reduction in prices is going to happen. So there is also an expectation the festival season for Q2 and Q3 should be reasonably good.
Okay, sure. Thank you very much and all the very best to you.
Thank you, sir. We have a next question from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, thanks for taking my question. What I wanted to check is, in terms of the cables and wires, we've seen a fairly sluggish growth of about 10% in terms of volume for some time. So what's happening out there? Have you seen the GST and e-way bill not really helping this particular product where commodity, as in the unorganized presence is fairly large?
See, there are two reasons for this. One is that the construction and real estate industry, without me telling you, you know that it's on doldrums. So there is very little demand for large housing. Very little demand for apartments across the country, and this is not a case with one city or two cities. Across the country, real estate is not growing. So that is there on one side. On the other side, yes, you're right that the GST has really not made any dent on unorganized competition. I'm sorry to say that in fact we have seen increased levels of bill selling and cross state movement of goods than the previous GST days. In fact, things have become worse for many branded players like us because all our products are moving to all over the country at different prices for cash sent by dealers. So completely all the market is disturbed, and you will hear the similar kind of feedback from all branded players of all building materials. What is happening is till the invoice-to-invoice matching happens, I don't see how, you can curb the, unauthorized trade. So I think the government is getting GST up to company to dealer sales. But beyond that, I don't think it's happening. So I'll ask Sudarshan to supplement.
In the VAT regime, most states had a 5% tax on wires. Okay. So even with the 18% GST, the tax incidence has gone up. So that's one of the that's one of the factors why wires business is not getting formalized.
So basically, yeah, your understanding is right. GST has not really helped us in reducing unorganized business. In fact, I'm told they're thriving more than ever. So we are waiting for the invoice-to-invoice matching feature. Yeah. Maybe it will happen in the next 1 year. Once that happens, every dealer also will be under scrutiny because he has made some purchases and then his sales are not matching up. So when invoice-to-invoice matching happens, we will start to see a much more tighter control on unorganized trade.
Got it. Sir, you pointed out an interesting observation about material moving from place to place all over the country. So the pricing, how about the pricing? Is our pricing for products across pan-India is same, or there is a differential pricing out there in non-South even now?
See, in wires, we have for the last maybe many years, 8-9 years, we have followed a single price. So the price at which what wires are sold in Delhi is the same price at which sold in Cochin, same as in Bangalore and Chennai. But what happens is, when dealers sell bills, they get different types of advantage. So that advantage they are passing it to the market.
Right. But for all other categories, our pricing is pan-India same, or is there still differential remaining?
I think for other categories, maybe there is a 2 to 3% price differential remaining between South and non-South, but largely we are seeing them getting converged. And I think it's a matter of 3 to 4 years before we see kind of uniform pricing. The margins in South and non-South is not only different because of price, it's also different because we sell different SKUs. So we sell, for example, if you take any category, we sell more of the premium variety of products in South and less premium variety in non-South. Because there we are a fighter brand and here we are a premium and established brand. So that is also one of the reasons for the difference in pricing. It's not only that we give more discounts, we also sell more premium products. Our product mix is more rich than South. Let me put it that way.
Fair point. Just last
sorry,
question.
Would you like to come back in the queue?
Certainly, sure. Thank you so much.
Thank you. We have a next question from the line of Abhinav Anand from SBI Cap Securities. Please go ahead.
Yeah, first on the new products, if you can throw some light as to what is your outlook on new products for the next, say, 3-4 years? I mean, how much of your revenues do you feel will be captured or will become as a percentage over the next 4-5 years from presently?
So I think today it's about 5%, and I think I can see switchgears growing very, very fast, and it's growing at almost 40-50%. And if you add modular switches, even it may be even higher. So both protection switchgear and modular switches, I see it as at least contributing 10% of our revenues in the very near future. Kitchen appliances is going to be slower because it's a heavily brand-driven business. And kitchen is kitchen appliances and utensils people buy is very prone to habit, and habitual change is very difficult. So it is very difficult for us to break the stranglehold of the established kitchen brands. Having said that, we are still growing well, so we may not have such a big growth like switchgears, but we will still account. So I think maybe in the next 3 to 5 years, these two put together should contribute about 15% of the revenues, up from 5%.
Okay. And secondly, you did highlight that the 15% growth trajectory for the next few years on sales is our target. In terms of margin, where do we see sales as 3 years hence?
So our EBITDA margins are around 20%, and last year we had a dip primarily because of the additional spend on A&P. We should revert back to 10%, and I think looking at our product portfolio and the structure, we will slowly move up towards around 12% in the next 4 to 5 years, gradually. once we stop investing, stop investing so much back into the business in terms of product, in terms of people, in terms of brand.
Okay, thanks a lot, sir.
Thank you.
Thank you, sir. Participants, to ask a question, please press *1 on your touchtone phone. We have a next question from the line of Abhijit Sinha from PI Square Investments. Please go ahead. Mr. Abhijit Sinha, your line is...
Finance
Mr. Abhijit Sinha, your line is... Thank you. We have a next question from the line of Achal Lohade from JM Financial. Please go ahead.
Hi.
Yes, sir. Please go ahead.
I just wanted to check about the tax rate. For the quarter, we have been about at around 22%, 23%. How do you see it going forward for FY19 and FY20 as a whole?
Yeah, the Q1 tax rate, it's 22%. It's basically a result of the Sikkim unit, the tax benefits arising out of Sikkim. For the full year, I would expect this to be at around 23.5%, and similar levels for next year.
All right, great. Thank you so much.
Thank you. Participants, to ask a question, please press star followed by 1 on your touchtone phone. We have a next question from the line of Romil Mehta from ICICI Direct. Please go ahead.
Hi sir, thanks for the opportunity. I wanted to ask a couple of questions. Like here we are seeing an expansion in EBITDA to like what we are expecting is it will be reverted back. So going forward, do we see the gross margins also expanding, or do we see them staying at the current levels?
I think gross margin probably will stay at the current levels. I think as we gain scale, the overheads will not rise as fast as the revenue, and that is what is going to drive the EBITDA expansion.
Right. And could you like give any numbers or anything where, because we are expecting a 15% volume growth, right? So any particular segment which will be driving the growth, which like the consumer durable, like any particular segment which will be driving the 15%, because electrical segment have been the growth has not been so great till right now. So
I think this year, if you see, for example, the summer season was bad. Temperatures were not high enough. So sales of stabilizers, sales of pumps, because water tables are high, have all taken a beating. In that quarter, we have had good growth in other products. So I think it's not fair to say that any one product will drive demand. In years when summer is good, probably stabilizer and pump and fan, etc. will drive demand. Years where summer is not so great, products like water heater, new products like switchgear, etc. will also drive the growth. So may not be, the only major change you will see probably is the new products growing up from 5% today to 6 and 7 and 10 and so on and so forth.
Okay, fine. Yeah. And just the last question, like what can be the outlook for consumer durables? I mean, going forward, what would be the how much percentage of the total sales do we expect the consumer durables to contribute in the, let's say, around 3 to 4 years and later on?
See, in consumer durable is also having a lot of large products like water heater and solar water heaters, where we are already number 1 in the market. So these kind of products may not grow at a very fast clip. But there are other products like kitchen appliances which can grow fast, and air coolers also which can grow fast. So their contribution may still be remaining same to the overall sales. Because each category, so electronics has got digital UPS and inverters which is growing very fast. Electronics has got these other electrical has got switch gears and modular switches which are growing fast, and durables have fan and kitchen appliances which are growing fast. So I don't see a huge shift in any of these percentages. We may not see any huge shift.
And just the last question. So, if currently the margins which we are seeing in the consumer durable segment is just 3%. So, what margins can we expect going forward? Like, do we see any operating leverage kicking in, or?
Yeah, definitely. I think consumer durable has got kitchen appliances, fan and air cooler, and we are heavily spending in these three categories. We are in investment mode. For example, water heater and solar water heater, our EBITDA margins are 12 to 14%. Then these are two established business. So that is the kind of margins, other durables also should make when we hit, full scale.
All right. Okay. Yeah. Thank you so much.
Thank you. We have next question from the line of Jay Kakkad from Haitong Securities. Please go ahead.
Yes, thanks for taking my question. Just wanted to understand this floods in Kerala. So you have many small units from where you source your products. Has there been any impact on the sourcing of products because of this?
No, luckily a lot of our units are in southern Kerala. That is in the Trivandrum district. And luckily the floods are mainly in Idukki, Kottayam and Alleppey districts. We have very few units in central part of Kerala, where mostly, central and, these three districts. So luckily Kollam and Trivandrum, which are the southern two tip of Kerala, is where most of the units are. And luckily they are they've not got battered so much as the other parts. So in fact, in that way, it has not impacted any operations.
Okay. So also on the air cooler side, so you deal in the durable space also because you have stabilizers. You also deal in the electrical space. On an overall market basis, how much of the sales in coolers will be, say, through electrical channel, through a durable channel, or through a kitchen appliance? So how is there a segregation, something of that that we can look at for the cooler sales?
Yeah, our senses air cooler is sold majorly by durable channel itself. So our sales is also coming from there. I think maybe 60-70% is by durables channel is what we understand. There may be specific cooler dealers in north and all that, but we are not tapping them yet because we are going with the channel that we know, which is the durable channel.
Okay. So that's all from my side. Thank you so much.
Thank you. We have next question from the line of Siddhant Chabria from HDFC Securities. Please go ahead.
Hi sir, I just wanted to confirm, out of this 30 crores in advertising, what was the one-time brand exercise pillow amount?
This is around 10C. I think some part of the activity, we started the activity in February. So when we started the activity, there are certain assets like hoarding, digital, other BTL kind of activities that were going on, and they are done over a period of 3 to 4 months. So that is the spillover we are talking about, and the amount is around 10 crores for the month of April and May.
Okay, and so my next question is, now that we are done with this one-time brand exercise, how has been the response from the trade channel and the consumers, and in which categories are we seeing stronger traction?
I'll let Aram, answer that question since he was the main architect behind the whole event.
The response has been very good. I think there has been a significant improvement in brand awareness and brand recognition in non-South. I think we had taken a multi-channel approach to communication. So, that really has helped to cut through. The other thing is, so we have converged our entire packaging to a single identity across all categories. So that has, helped to significantly, improve our, identity and visibility and the shelf throw. The third thing that, what we have gathered from trade is the fact that, the new brand identity is standing out, among in the competitive space because of the uniqueness of the identity. And what we are finding is a number of players are what I would say moving to copy, and we have significantly stepped up our legal activities to protect our identity. So I think overall it has been extremely well received. Our objective primarily in making this change has been twofold. One is to make sure that the brand evolves in a contemporary manner and is able to embrace the younger and the evolving the consumers who are coming into the consumption space as we speak and in the coming 10-15 years. And second is to embrace an identity which can support the future growth of the brand as it progressively expands its product offerings to leverage the brand equity of brand V-Guard. So I think both these objectives are extremely well served, and there has been very strong positive traction on the brand identity shift.
Okay, thank you. That's it from my end.
Thank you, sir. Participants, to ask a question, please press star followed by 1 on your touchtone phone. We have a next question from the line of Vinod Chari from Dolat Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. This is pertaining to one of the remarks that you made, in reply to one of the other questions. You mentioned that in South you have a premium stroke pricing power, while that is not that high in North, non-South. Now, next maybe 3-5 years down the line, if you're going to expand non-South and non-South becomes a bigger contributor, how do you see the margin trajectory move? You also mentioned that from 10% you're targeting margin to move towards 12% range. Can you share some of your plans in terms of how that margin trajectory would move?
See, what I meant is our product mix is more rich in South and not so rich in non-South. What it means is, see, when you are a market leader and when you have been in the market for 35-40 years in a particular market, let's take like Bangalore for example, we are the number one brand in most of the categories we play there. So when you are the number one brand, you are also sitting in all the number one stores in those markets. We are present in any store, everywhere, because without us, it is not possible for the shopkeeper to conduct his business. So he is forced to stock our brand not because he loves us, but he is forced to do it because customers ask for it. Okay, so that forces that gives us a unique power to push certain premium products, and even customers don't mind buying those premium products there. Now, when you go to somewhere like Delhi, it is again 8-year-old or 10-year-old market for us. We are not going to be present in every premium store there. We are going to be present in maybe 20% of the premium stores. We are going to be present of maybe 30% of all stores. And there we are actually fighting for shelf space with 8 or 9 other brands. And maybe only 10% of the customers today are asking for V-Guard. The rest of the 90% of sale is happening because the dealer is, converting the sale. So in that scenario, if we tell the dealer to sell our most exclusive, exquisite, expensive product, he is not going to be succeeding because he is going to have to tell the customer to take a risk and buy our brand, which is also more expensive than some of the other options the customer is seeing. So as we become stronger, and the brand identity launch has helped us to do that, partners who are able to sell premium products, and slowly our mix in non-South will become similar to the mix in South. I'll just ask Ram also to supplement.
Yeah, I just want to add 2 more, observations. I think fundamentally, Mithun was talking about the structure of the business, where to some degree, even the market in South is more premium than non-South. But to give you an idea, in fact, in the last 4 years, we have been working to converge, our, margins in South and non-South. I think at the overall portfolio level, we are about, 1% behind. Some of it is also coming from product mix because, certain type of, demand is there for certain type of SKUs in some geography. And some small part, at a weighted average level is really related to a real price difference which is happening in the market. Because, we give some more scheme because the velocity of our product in non-South is not as strong as the velocity in South. Yeah. So, trade partners take more time and our distributors take more time to churn the product portfolio. I think also as we had, we have also successfully, overcome the GST transition. GST has posed its own challenges to unorganized business, and we were in outsourcing, and we used to source from smaller suppliers, yeah, and we had some arbitrage which allowed us to compete with larger players, yeah? And that disadvantage also we have overcome, as you can see from our gross margin. So I think most importantly with our brand relaunch, I think we have I would say directionally we have addressed the challenge of maintaining margins in non-South because the new brand identity of brand V-Guard is is allowing for or is providing motivations for a younger and newer consumer to embrace a newer brand. So the transition to and the risk to embrace an unfamiliar brand is going away because this brand is sitting on the shelf. It is looking more smarter than other packs, yeah. And also, if you look at our packaging, the elements that we have put on the packaging, are significantly enhancing consumers' confidence and minimizing his perception of risk towards entering a newer brand. So I think the brand relaunch itself, is going to be a significant enabler for V-Guard to do business in non-South on even footing and strong terms. This is something we will see in the coming period, in the coming 2 to 3 years.
Sure, sir. So internally, what kind of time frame do you have for your products to move from a push product to a pull product in non-South?
Yeah, I think this is a journey, and I think, I mean, like from 2008-9 days, when literally, people used to ask me, when I used to tell them, they used to ask me, is V-Guard a security company or something like that? It has definitely changed in the last 10 years. So I can say the recall, the awareness is significantly higher. I think there is no no dealer in India today. There are 100,000 dealers in India who doesn't know about V-Guard today. Consumer-wise, maybe our awareness is for maybe, only maybe 20-25% of the non-South market, vis-a-vis maybe 60, 70 or 80% of the South market, or even sometimes 100% of the South market. So it's always a journey, and I'm sure that in this brand relaunch is just the first step of many things to come, and we will do a number of these kind of activities which will enable us to have top of mind awareness in those markets. But I can tell you something that every year, if today 20-25% of the consumer population know about V-Guard, I can say with great certainty that every year maybe a 10% addition in that will happen. So about in 4 to 5 years time we will see a very different picture than what we have today.
Sure, sir. All the best for your efforts.
Thank you.
Thank you, sir. We have a next question from the line of Mehul Mehta from Sher Khan. Please go ahead.
Good evening, team. This is with regard to other expenses. If I look at excluding advertising spend, in quarter 1 FY19, we have spent about 68 crores on other expenses, excluding advertising, which was 49 crores in quarter 4 FY18, like to like. So what has led to this 39% increase in terms of other expenses? Are there any one-offs?
Okay, we're just checking the numbers, please hold.
Okay. Other expenses, Q1 this year excluding advertising was 66. Corresponding Q1 last year was 60. So between them it's just a normal inflation.
I'm talking about quarter 4 sequentially, sir.
Yeah, sequentially quarter 4 was 112 minus 45 of advertising, which was 67. So 67 became 66. So it's not much of a change.
So like to say, if I take Q1 FY19, you are saying 29 crores is purely above the line expenditure, advertising expenditure. So including sales and promotion, what would it be, the number?
Sales and promotion now go off the top line, so I don't have that handy. I'll just check from the head.
So some of the sales and promotion expenditure again is removed from turnover and expenditure due to the new India standard.
Total spend ad plus promotions was 6.4% of turnover.
That's
6.4%. Which you are saying 4.7% is above the line, but including is 6.4%. Am I correct?
Yeah.
Oh, thanks, sir.
Yes, correct. 4.7 and then 6.4. Yeah.
Got it. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Bhargav Buddhadev from Ambit Capital. Sir, over to you.
Yes, sir, I have a couple of questions. One is that it's been almost a year since we've launched Salesforce.com, and essentially one of the tools which you had highlighted was on demand forecasting. So can we sort of build in a reduction in inventory days now that the platform has been set up since a year?
So I'll answer part of this and I'll hand it over to Ram. Of course, now the entire demand forecasting and order management, order pipeline is happening through Salesforce. The meetings and mapping of dealers is also happening to Salesforce. The branch managers have been trained and are getting retrained every few months to ask the right kind of questions to sales executives on whether they're adhering to a beat plan, and we are asking the branch managers whether they're making a beat plan for their executives. So we are basically putting all the activities, like daily sales reporting and all those things into through Salesforce.com. So we are using this platform to actually run the sales system. Basically, it gives us more flexibility. So when revenue in a certain branch is not growing, we first pull out all the Salesforce data. We see for each category, each product in charge, each executive, how many meetings he is doing in a month, which are the dealers he has met with. And we also run reports, how many unique dealers he is visiting in a month and how new unique dealers he is visiting in a month. So a lot of data is being now used. So the discussions with branch managers are now becoming more data driven and qualitative and not simply, basically don't let them give a random, excuse. So there is a clear correlation on the work and legwork being done by executives and product in charges and the revenue growth happening from branches. I'll just ask Ram to supplement.
See, the Salesforce.com, we had a two-step approach to deploying Salesforce.com. In stage one, we wanted to standardize the workflows, the systems, and the way we conduct our sales management activities. This was critical because, over the last 7 years, we had grown by hiring talent from outside, particularly in non-South. So there are different ways in which things were being done in different parts of the country. So Salesforce.com primary objective was that. So we had a very smooth implementation of Salesforce.com, and we have now standardized our processes, and in fact just last week the team was sharing with us that utilization of Salesforce.com consistently has gone up to around 90%. Order management of course is 100%, but even for other supporting activities. This was our primary objective. The secondary objective, the next stage objective towards which we haven't started work yet is to support what I would say enhanced forecasting as well as what I would say is how to utilize this for cross-selling and upselling and improving the financial health of our sales portfolio and customer profitability. So that the process required and the workflow required, right, to design and enable that is yet to be put in place. But independent of this, there is a continuous process for improving sales forecasting, and that is happening continuously. I think what we have observed is that over a period of time we have become efficient in managing working capital. The challenges with working capital management are fundamentally arising from our inability, from our supplier flexibility Because what happens is, the seasonal, most of our products are season driven, and the season window is a short window of 3 months. So by the time, we give, the plan to our suppliers, and, the suppliers are able to, they organize their material, and by the time we are able to sense the season is going other way, it starts to get too late. So I think, to improve our, inventory, levels, we need to work on both sides. Of course, we need to improve our forecasting, but we also need to improve supplier flexibility. I think that will happen as more and more manufacturing moves in-house.
So to give you an answer, our forecasting accuracies have improved in the last 3 years since we started Udan, and our inventory levels have also shrunk. So let me put it this way: had we not done Udan and the proper S&OP process and the kind of way we are working today, had a GST happen and a demon happen and a bad season happen, all this in the span of 18 months, you would be sitting and looking at a very different inventory number than what we have today. So, this is still a very manageable level of inventory what we have received. It is not entirely the fault of the sales force, that they have forecasted, because they are forecasting, looking at, reading about IMD, Indian Meteorology Department report saying that we'll have very warm summer and all that. Finally, nothing has happened. So obviously the stock is, piled up and it's sitting. But even after that, if you look at June numbers, our inventory has significantly come down. So June inventory is down, actually much, our free cash flows are almost 65 crores or something for the first quarter. So both the debtors and inventories have come down from the March levels. But we have not obviously published, I'm not sure whether we have published inventory numbers.
We have given a 2 days reduction in working capital.
Yeah, so there has been a 2-day reduction in working capital. This is despite the fact that we have had a bad season and
inventory came down by 3 days.
Inventory has come down by 3 days.
Compared to same period.
Had we had a normal season, inventory would have probably come down by 10 to 15 days. So that's probably the difference.
And so my last question is that within South, our market share in Tamil Nadu has historically been very weak, but I think post GST implementation, things have changed in that state. So, sir, any sort of improvement we are seeing in terms of market share in Tamil Nadu?
So, barring Chennai, we are doing very well in terms of wires. I think wires and cable sales are growing at a CAGR of 25-30% for the last 2 years. So I think we are on a very strong footing, and I think when the invoice-to-invoice matching starts, I think even Chennai market also will open up, because the unorganized guys there will still find it difficult. But otherwise, we have seen that generally demand for wires, demand for switch gears, modular switches have all increased for branded companies post GST. It's a general statement I would like to make.
Okay, sir. Would you want to give any closing comments?
No, I think I would like to thank Bhargav and the Ambit team for hosting this call for us, and thank you all for your patient listening.
Yeah, thank you very much. Vikram, you may want to close the call.
Thank you very much, sir. Ladies and gentlemen, on behalf of Ambit Capital, that concludes this conference call.
Please subscribe and press the bell icon to never miss another update.